Thanks to everybody for joining us today for this webinar entitled Optimizing a Dividend Recap in the Current Environment. Today's call is being co-hosted by Accordion and Configure Partners. And for those of you who can't stick around for the entire webinar, today's call is being recorded and will be available on both Accordion's and Configure's websites. Also, participants can feel free to reach out directly to any of the three gentlemen you see here up on the screen, and we'll be happy to send you over a link. Today, we have joining us on the call Shari Ahmed from Accordion, Joseph Weissglass from Configure Partners, and my name is Steve Schweitzer from Accordion. Today, we'll take about 45 minutes to talk about the current market environment for dividend recaps, and then we'll discuss how Accordion and Configure can be helpful as you prepare or think about tapping the credit markets for a dividend transaction. And then we'll leave about 15 minutes or so at the end for questions. Just so you know, on the bottom of your screen, there's a Q&A box. So if you do have a question, feel free to tap that box and we'll take those questions live. Before we jump into the materials, just wanted to take a minute to introduce ourselves and give our backgrounds. As I said, my name is Steve Schweitzer. I'm an MD in the Transaction Execution Services practice at Accordion. Before joining Accordion, I spent about 22 years as an analyst and portfolio manager at Schenkman Capital in New York, where I oversaw multi-billion-dollar portfolios of leveraged loans and bonds for institutional investors, pension funds, family offices, endowments, foundations, and the like. I also headed up our capital markets group, where I worked with underwriters to price and structure new issues, such as dividends, that were coming to the market. So a lot of experience in the leveraged finance industry across a panoply of different sectors, as well as a lot of interaction with the private equity and banking community. With that, I'll turn it over to Shari to introduce himself and also Joseph as well.
Thanks, Steve. Hi, everyone. I'm Shari Ahmed. I'm an MD in the Transaction Execution Services team at Accordion. By way of background, been with the firm for about 8 years. Prior to that, I spent about 8-9 years in direct private equity investing, including working at the International Finance Corporation, the private equity arm of the World Bank Group, managing 100 billion plus at the time. Prior to that, I was with Goldman Sachs in New York.
And hi, everybody. I'm Joe Weissglass, Managing Director with Configure Partners. I want to say thank you to the Accordion team for having me today. I traced my background through Guggenheim Securities, and prior to that, I was part of the Barclays leveraged finance practice as well. We'll have a chance to introduce the practices once we get into the materials. But again, thank you for being here.
Thanks, Joseph. Just a quick overview of our respective firms. We won't spend too much time on that, but just for context, as many of you already know, Accordion is a private equity-focused financial and technology consulting firm. We have a specific focus on the office of the CFO. That's what we are known for in the market, and that's what we've been doing for the last 15 years. Our work covers the entire life cycle of a private equity-backed portfolio company, and we'll get more into that in a second. We have 11 offices, 10 in the US and 1 in India, and we are industry agnostic. As far as our interactions with private equity funds are concerned, we work with the top 300 plus private equity sponsors in the market, starting from the mega caps all the way down to the mid-market and the lower mid-market private equity funds and their respective portfolio companies. We are industry agnostic. Over the course of the last 15 years, we've practically worked across every industry that the bulk of the private equity investment firms have been focused on. So while we are functionally driven, we are industry agnostic. We have about 8-9 practice areas. Again, won't get into too much of detail here, but what's important to remember is our services span across the life cycle of a PE-backed portfolio company. We can do soup to nuts, anything that touches the office of the CFO, be it operational technical accounting, the FP&A function, M&A or transaction execution, and turnaround and restructuring. We are also backed by deep technologists within our ranks. Within our CFO technology and DNA teams, the data and analytics team, we have expertise to deploy all the leading and prevalent finance and accounting systems in the market. Think ERPs, EPMs, CPMs, etc. We also provide and offer interim leadership roles in select situations.
So from Configure's perspective, just quick overview of our platform. The easiest way really to think about us is we're an outsourced debt placement or debt advisory practice, really a boutique focus specifically on the debt advisory. Our fundamental role is to save private equity time, increase the certainty of close and the transaction they're focused on, help them close more deals, and then ultimately drive competition to optimize terms across lenders. On the next page, you'll see one more page. You'll see our team. We have about 25 professionals. We're all focused on debt advisory. Again, ranging from new platform LBO, dividend recap, which would be the topic of conversation today, all the way down to special situations type refinancings as well. Our real value prop is that we are consistently in the market. And so this just flash of data, if you will, is pulled together in May of this year. We're probably up to 130 debt placement engagements. We're closing on an $11 billion of engaged debt placement at this point in time. All this just to reflect very, very high level activity across all 25 of those professionals in market pretty consistently with new deals, new deal opportunities, able to bring the right lenders to those situations. We also are industry agnostic. And so you'll see here at least how we divvy up the world into kind of core industry groups. We really touch just about everything we have in market right now. Healthcare, we have restaurants, we have a couple of consumer deals, we have a couple of automotive deals, we have a couple of tech deals, healthcare deal. So again, across all industries at any given point in time. I've mentioned, our focus is the middle market. So we think of that as 25 million on kind of the low end to $500 million on the high end. We've gone bigger. Right now we have a $600+ million deal in market, but at the end of the day, we're really focused on what we'll call the core middle market across all structures, unitranche obviously being the most popular, but also split lien, senior, junior, and some more kind of hybrid structures as well. And then finally, I think this is really a stat that I'm proud of and kind of a hallmark of our practice. We're very, very much focused on repeat client base. So greater than 90% of our business, of our revenue in a given year comes from repeat clients, and many of those use us multiple times in a given year. So 3 or more times in a given year. And here's just kind of a flash of our client base.
Thanks. If you go to the next page, if you look at this page, we all know there's a number of paths that private equity sponsors can go down if they look to monetize a company. We've got a couple listed here: IPO, sale of business, partial exit, and then of course the topic that we're talking about today is dividend recaps. But if you look at today's environment, sales to either strategics or financials, or IPOs by portfolio companies of PE firms have been down really significantly over the past couple of quarters following a surge in 2021. And the reasons are all pretty basic. Bid-ask spreads between what sellers want and what buyers are willing to pay have really widened out. The economy's really slowed down, although it's still positive. We're tracking kind of 2% earnings growth this year. And then, of course, the elephant in the room this year is that interest rates have risen considerably, with the Fed having raised rates by over 500 basis points over the last 18 months or so. So just as a point of reference, you all know SOFR, or the base rate, has risen from basically 0 18 months ago to between 5.25% and 5.5%. So financing costs have been much more expensive. So again, this all means that transactions are way down, M&A is way down, IPO volume is way down. So if sponsors aren't able to IPO or sell their portfolio companies, one avenue they may want to consider going down is a dividend recap. And the reason why dividend recaps are particularly compelling at this point in time is listed here on the right side of the page. You can get to the market pretty quickly. You can be opportunistic about it. For a sponsor group, it boosts the IRR to the GP. The limited partners get liquidity, which, as I said before, frequently gets recycled back into future funds. The sponsor gets to maintain control of the business. It buys the sponsor a little bit of time to wait for a higher exit valuation sometime in the future. And there is substantial cash around the private debt markets and the BDCs that require yield. So lenders do have a lot of capital to put to work. So there's definitely an appetite there, especially for companies where debt investors have a high degree of confidence that the company is going to delever. So if you flip over to the next page, page 15, these are just some of the bullet points that we put together. about why now might be a really good time. I'm not going to read them all off, but effectively, with equity markets having risen to the point they are this year, and we have another positive day today, there's more of an equity cushion beneath the bonds. Spreads in the high yield market are now at about 380 over treasuries after the close of business on Friday. So that is typically tells you that the market is not anticipating a recession or meaningful increase in default rates. And really, most importantly, the Fed looks like it's done or close to done in this rate hike cycle. We'll know more in the next 48 hours or so. The Fed decision is actually due out on Wednesday, but we'll have a lot more clarity in the next couple of days. And then the last couple of points that I'll kind of touch on in the next couple of slides are dividend recaps are getting done, and we'll give you a few examples of recent deals on the next page. And then finally, recent earnings, although not stellar, have been positive. So there's a lot of pretty compelling reasons why dividend recaps are a viable alternative in the market now. If you look at this page, these are recent dividend recaps. And if you look at the recent ones that have hit the syndicated bank loan market in the past couple of months, not only are deals getting done with increasing frequency, but they've also come from a bunch of different industries, and they've come from a bunch of different private equity sponsors. And really the most important key takeaway, and I'll give you a couple of examples of this, is that the new issues that are coming to the market for dividend recaps are pricing at yields that are lower than initially envisioned. And that means that investor demand is robust. So to give you just a couple of quick examples, line one, AOC, which is that has nothing to do with the liberal Democratic Congresswoman from Queens. AOC is actually a specialty resin company. But the way to read this chart is that when initially envisioned, Bank of America was bringing this deal to market for this Lone Star sponsored company. And the initial price talk when they first announced the deal was SOFR plus 425 between 98 and 98.5 offer price. At the end of the day, the deal actually got upsized from $375 to $400 million. The initial dividend actually got upsized also by $25 million. And the final price was actually tighter than originally envisioned. So although it did come at LIBOR plus 425, it came at a higher OID of 98 3/4. Similarly, you can look at CHG on the same page. That was originally envisioned to come around 10.25%, priced inside of 10%. And just to give you a sense, there's actually a dividend recap deal in the market today out of Europe for a company called Cegid, C-E-G-I-D, led by Barclays, and that's majority owned by Silver Lake. So, the ink is barely dry on some of these deals, and there's already new deals that are starting to hit the market even as we speak today. If you flip over to the next page, one of the key takeaways from this page is that if you look at the second word in each one of these bullet points, Moody's has affirmed the ratings of these three deals that are highlighted here, Lakeshore Learning, CHG, and Alex Partners. They've come in all different spaces, different sponsors, and the ratings have been, again, affirmed. And they're saying that although leverage is ticking up a bit, if the company has stable cash flows, if the company has growth, if the company has liquidity, if the company is generating free cash flow and will delever going forward, we're going to leave the ratings unchanged. And since, as you know, a lot of syndicated bank loans wind up in CLOs, that's very, very important to the buyers of this debt. So the rating agencies have said, hey, not only if you're going to take up leverage to a reasonable amount, we are actually going to affirm the ratings and not penalize you for taking a dividend. And then just finally, this is a chart that shows you what dividend-related loan volume has looked like over the past several years. Typically, it represents around 10% of the market. And as you can see, there's been a notable tick up lately. This is only updated through August 9th. And if you add in the deals that I just referenced in the last couple of minutes, that number will continue to rise going forward for the next month or two. So with that, I'll turn it over to you, Joseph.
So we're going to spend some time. We'll start high level here with some of the data that is, I'd say, visible from a public markets perspective. Configure spends most of our time really in the private credit markets. But some of these features, some of these considerations, they're consistent regardless. And so when you think about the opportunity to tap the dividend recap market, really a couple of features you're typically looking for. I think the first one being relatively obvious, that there's leverageability or debt capacity in excess of what the portfolio company has on it today. That's what creates your dividend capacity. The consistent free cash flow that Steve mentioned as well. This is really a way to think of it as an alternative to selling the business, an IPO. It can be done in conjunction actually with these GP-led continuation vehicles, which have been just very, very popular, really late half of last year and some of the beginning months of this year. So we often see these divvy recap financings done in conjunction with a GP-led. But at the end of the day, this partially realizes returns, but allows the sponsor to continue driving value, the GP to continue driving value, to capture the upside in a more favorable exit environment. Obviously, this is all a reaction right now to an unfavorable exit environment, generally speaking. The denominator effect, which is the most popular term thrown around in the private equity media these days, and how do sponsors return capital to LPs, which, to Steve's point, oftentimes just recirculates right back into the next fund. So from a dividend recap candidate perspective, when you look here on the right side of the page here at the top, a lot of this, again, will be relatively self-evident, but consistent historical EBITDA. Ideally, it's relatively clean with minimal adjustments, revenue visibility, customer relationship contracts, high barriers to entry. All of those things are credit positives. I'd say consistent operations, so no major changes in how the company operates, and ideally in a non-cyclical industry. And then we oftentimes lean into, particularly nowadays, enterprise value, implied equity cushion, to get lenders comfortable with an implied LTV, which is a major focus, I'd say, of the market right now. And then at the end of the day, private equity sponsorship, ownership is a preferred structure as compared to a family or founder-owned business, which just tends to be more difficult. The chart here at the bottom of the page, this is a number of transactions type page. So here you see really in the early part of 2020, so this is right around the COVID period, uncertain capital markets, low dividend recap activity. Things started to become more certain in really the late part of 2020 and early 2021, and you saw very, very high dividend recap activity. And then again, as we moved into this recessionary environment that we're in today, things got quiet really through most of 2022, and you're starting to see, and certainly we're starting to see, the early signs of that stability. And if you look at our dividend recap pipeline, at least it's up significantly, and you kind of see that starting to show up in the publicly available information as well. Page 21 is where we really double click and share, I'd say, some statistics from a recent dividend recap that we just completed. So this was call it plus or minus $250 million dividend recap facility done in the private credit markets. And none of this is publicly available information, but we took the opportunity, because we were running a very broad process. I think we went out to quite a number of lenders here. We took the opportunity to survey those lenders as to their appetite for dividend recaps. And you can see here close to 60% of the lenders that we talked to either were interested in dividend recaps as a use of proceeds, or they actually submitted a term sheet on the deal that we had in market. And conversely, just north of 40% of the lenders we talked to said it doesn't really matter what the credit profile of the underlying borrower. We're not providing a dividend. We're not funding into that sort of use of proceeds. And so we're out on that basis alone. And so I think, this sheds some light into really lender appetite in what was a sizable dividend recap with a relatively tough credit profile. Lender appetite still exists for these types of deals, which, again, to Steve's point earlier, suggests that now might be a good time to consider kind of queuing up dividend recap activities, or at least exploring those options. The next page, and this really gets into something that's pretty important right now in private credit, and this relies on some data that comes out of Configure's survey of private credit. You can see that second bar really from the left-hand side on the top side of the page, suggesting that industry-specific considerations are increasingly important for private credit, which means they are evaluating new credit opportunities through the lens of industry specific issues as opposed to banks where banks have really just pulled back writ large from credit. And so we took, again, the opportunity when we were in market, we took the opportunity to survey private credit across the different industries where they were focused, where they were more aggressive versus less aggressive. And you can see here on the next page, the industries where on the right-hand side of the page, lenders are being less aggressive. And so building products, consumer products, automotive, again, not likely to be much of a surprise. Conversely, on the left-hand side of the page, food and bev, A&D, healthcare, where lenders are being more aggressive. And the takeaway here really is that identifying the right lender for the right opportunity in the right industry in at least the portion of the market where we exist is increasingly important and something that we're very focused on.
Thanks, Joseph. We'll spend the next few minutes just talking about what role can Accordion play in these debt transactions and how we can support the portfolio companies. Again, our goal in Dividend Recap initial prep engagements where we prepare these companies for the debt transaction is very simple. The focus is on minimizing the overall transaction timeline and ensuring that you get the best potential terms. How do we engage with portfolio companies to get them to this end goal? We split the engagement into two phases. In the first phase, the preparation phase, we actually step into management's role. We prepare all the requisite analytics that are required for the overall debt transaction. We're able to do this effectively because many of us have sat in the CFO's role, CFO's seat, and the controller seat, etc. We are intimately familiar with the systems that most frequently use accounting and finance systems that exist at these portfolio companies and are able to work in a pretty self-guided fashion to ensure that we have a consistent data-driven story to tell for the lender, to share with the lender. Along the way, we are also able to do any low-hanging merger integration work, which may not have been completed along the way. Just to give you an example, even simple questions such as a consolidated pipeline or consolidated backlog often becomes challenging for companies that have gone through significant M&A, which, as you know, a lot of PE-backed portfolio companies have. So we actually address all those data challenges, a lot of that validation work in that preparation phase. So once the company actually gets into the diligence phase with the respective lender, it's a smooth process. The second phase, as I mentioned, is the diligence support phase itself, where we can engage with a single lender or multiple lenders, depending on how broad the process is. By this time, we would have already populated the data room, help prepare the requisite marketing material on behalf of management, working alongside the likes of Configure and other advisors to prepare all the requisite materials to ensure that the overall diligence phase goes pretty smooth. We will support the company through the initial and the confirmatory diligence all the way through close. This ensures that in case you do want to run a broad process, it runs really smoothly. On top of that, any inbound questions that come during this process, we become the first line of defense on behalf of management and provide those and turn around those answers, the diligence questions and the answers in a very quick fashion, which in turn acknowledges or provides comfort to the lender that the company itself is buttoned up and the underlying story is consistent. Just a couple of key areas as to how we're able to support these dividend recaps and where we can optimize the process. First and foremost, our work enables a much higher likelihood of a successful debt raise. In one of the slides that Joseph talked about on the right-hand side, I think one of the first few things that is attractive to the lender is a consistent and clean cash flow story and financials. That's our first line of business. When we step into these roles, we make sure that the historical data, everything that is impacting cash flows, from operational data to management reporting to audited financials, are all ticking in time and are telling a consistent story. As a result of this, we're able to get the best potential terms for the debt raise itself. One of the value adds that we bring in these situations is we have folks with a deep experience within the credit environment, having sat in the lender's shoes themselves. Steve spent over 2 decades as a lender himself. And as a result of that, we're able to front run a lot of this diligence process before the company even goes into the market. This in terms avoids any surprises and ensures a very streamlined process overall. One of the biggest help that we provide in these situations is effectively doing all the work on behalf of the management, which is essentially providing management bandwidth. I'm sure many of you who have been in investor shoes or have been in management teams would appreciate the fact that transaction work does take the focus away from the day-to-day operations of the business. So our presence in these transactions ensures that management stays aligned and focused on business and operations, whereas we're doing the bulk of the heavy lifting in the transaction itself. Our work helps escalate management's perception as well, which, as you know, indirectly impacts the overall pricing and the terms of the loan, making sure that the outputs that lenders are receiving are consistent, streamlined, and management teams are prepared accordingly for those diligence interactions, ensures that they put their best foot forward and in turn are able to get better terms. Validation and data-driven approach we've covered already, so won't dig too much into that. And then lastly, having this, making sure that this work gets done upfront before the diligence actually starts would allow many companies and sponsors to actually run in parallel a pretty broad process with multiple lenders. Because a lot of the work has been done upfront, we can take inbound requests from multiple lenders at the same time instead of staggering it if that is approached. So this in turn, again, obviously ensures the best potential outcomes in terms for the portfolio companies. This is a quick visualization of how we work. Again, like I mentioned, we serve as an extension of the management team. We are not a PowerPoint shop. We are hands-on keyboards. We'll get into our cross-functional team on the next slide. But basically, given our skill set, we're able to work in a pretty self-guided fashion with minimal input from management team itself. We're able to plug in directly into the systems, work in messy data environments, and are able to navigate with all the stakeholders involved, including the sponsors and the third-party providers and the lenders themselves. This is really what differentiates us and allows us to work effectively with portfolio companies. It's a cross-functional team within Accordion, which separates us and allows us to work effectively. I mean, to get into some of the skill sets, first and foremost, we have sat in, many of us have sat in the investor seat, both private equity investors and the lenders. On top of that, the legacy of the firm, as you know, is the office of the CFO. We have numerous CFOs and FP&A folks within our ranks that can work effectively with the teams, not only the management team itself, but also interact and directly with the system to get to prepare the requisite analytics and support the overall credit story. We have investment banking and accounting, including QFE experience as well, which allows us to navigate through all stakeholders pretty effectively on behalf of management. Last but not least, we have over 200 plus data engineers that can really drive messy and disparate data environments to drive themes that can support the overarching story, overarching credit story. Often at times, we're able to tap into new data sets and create analytics that actually help bolster the stories, new information which is surfaced, which management team itself may not have seen in the past. As a result of this cross-functional team, what we're able to do is significantly minimize the overall transaction timelines to about 3 to 6 weeks for the preparation phase and ensure the best potential terms in the process. Just quickly touching upon what to look for when you are looking at your portfolio companies. What are the use cases where we serve best, where we can create the most impact in getting the best possible outcomes of a dividend recap? Starting from left to right, one of the most frequent use cases that we come across are companies that have had an acquisitive history. As I'm sure many of you have experienced firsthand, a lot of time merger integration is not complete or is partially complete in these portfolio companies. As a result, when you actually step into a diligence process itself, even the most simple ask, like I mentioned before, having consolidated pipelines, consolidated backlogs, could become really tricky. That's where we're able to do low-hanging merger integration work without spending a lot of money to actually prepare a consolidated story which can actually support, which can hold water during the diligence process. The second most common use case that we see is at companies which operate in messy data environments. Think healthier companies, think SaaS companies where you're dealing with millions and millions of rows of transactional level data. Oftentimes we see that these companies do not have sufficient systems to digest that data, analyze that data, and draw meaningful takeaways from it. Coupled with management team often lacking the requisite data and analytics skill set to actually work with large data sets. These are situations where we have been extremely effective for companies. And then lastly, again, a very common use case is for a CFO team or CFO offices which are stretched thin. The office of the CFO is a cost center. Majority of the time at PE-backed companies, we observe that they're understaffed, they're stretched thin with the day-to-day operations of the business anyways, and do not have the bandwidth and often at times the requisite M&A experience to support a debt or an equity transaction. That's where we become the first line of defense and help support them to get through a transaction successfully.
Great, thanks, Shari. And just to wrap up before we turn it over to Q&A, if you're a sponsor and you're contemplating taking a dividend, what should you look for? What types of companies make this a really good alternative? Joseph and Shari both touched on this. Really, the key is consistency and predictability of cash flow, cash available for debt repayment, a clear path to delevering, a credit that is strong, and rates that are stable and not volatile in the market environment. And then really importantly, if the added interest expense doesn't hamper the company's ability to reinvest back in the business for CapEx, et cetera. So if all of those types of companies, that's kind of the types of companies that the market is being receptive to right now. That's the formula really for success. And the second box, when is the right time to say Accordion, configure, hey, how can we execute a successful transaction in relatively short order and really minimize the cost of debt capital? And the answer is when the targeted exit valuation just isn't there and doesn't represent the intrinsic value of the business, when the IPO market is closed, when you need to return capital to LPs, and then when the company's been active in the acquisition environment, when there's disparate CRM systems, which Shari kind of talked about, and when the management is really stretched thin on internal initiatives such as technology implementation or something else, that's a really opportune time to think about this as an alternative. And then finally, why might now be a good time for a dividend recap? And we talked about these on the slides that I presented earlier. Deals are getting done. They're not only getting done, but they're pricing on the tight side of talk and they're being upsized. We're nearing the end of the rate cycle. M&A is still lackluster. You've got historically tight spreads in high yield. The economy's okay for right now, and really LPs need and want capital back. So these are all reasons why you might want to think about such a transaction in this type of environment. Next page. And then Shari and Joseph, you want?
Yeah, just to wrap it all up, quick takeaways from both Accordion and Configure. Where can we be helpful to portfolio companies that are looking to do a debt raise or a dividend recap? Again, to summarize, we help minimize the cost of debt by bolstering the credit story. We help prepare, validate data and KPIs to make sure that a consistent story that could be defended during diligence is available. We ensure that management is not distracted by providing them the requisite bandwidth. And we help prepare all the requisite materials for debt raise. So essentially, we can do it on behalf of the management, and we can do it pretty quickly. Typically, in most cases, we can get mobilized really fast and get the company prepared within a matter of 3 to 6 weeks, assuming no significant data challenges. Joseph?
And from Configure's perspective, I'd say, we typically get involved, albeit in a light touch way, very early in the process. So as you're having initial conversations with your investment committee, initial conversations internally as to, the art of the possible and the options, typically weeks, certainly weeks, if not months ahead of time, we are kind of giving initial reads on what we think would clear the market. And it's very easy for us to do hundreds of lender conversations a week. So feel free to call us early on to get just kind of a read as far as what's available. And then when the time does come, typically we're working and in fact managing oftentimes some of the third-party work that goes into the marketing process. So Shari talked about QOV work, but there's also market studies and we're very involved there, working with the team to develop marketing materials, design the lender outreach. We ultimately manage all of the diligence and have systems in place for that, prepare the management presentation and coach the management team to deliver the management presentation, and then working through obviously negotiating terms with lenders and managing the documentation process with counsel. So very hands-on approach, really from start to finish from Configure side.
So
I think-
that concludes the webinar, and yeah, you've got our contact information here. If you'd like to ask a question, we have a Q&A button again on the bottom of your screen. If there's anything you'd like anybody on here to answer or discuss in a little bit more detail, feel free to type your question in that box now. Anybody have any questions? Feel free to jump in. We have one question. Yeah, the presentation will be available for future listing. It'll be posted to both Configure's website and Accordion's website, but certainly you can feel free to reach out to any of the gentlemen on the screen, and we'd be happy to help you find access to it.
And then we've got another question here about what sort of leverage are we seeing in recaps today. So I'd say generally speaking, and this is across the market for financings writ large, fixed charge coverage and LTV tend to be the governors on leverage at the moment. And so it's a bit of an it depends type answer. Typically, though, we're seeing what I call replacement leverage or dividend recap leverage coming in about a half turn lower than the original acquisition leverage. So, for example, the example we gave earlier was a 4 3/4 times deal when we did the initial financing, and when we came in more like 4 1/4 on the dividend recap, the replacement financing. Part of that was driven by FCCR and LTV, but I think also driven candidly driven more by the fact that it's expected to be a lower leverage relative to the acquisition capital structure. From a follow-up question here, what terms are most negotiable? So lenders are sticking a little bit closer to their guns, a little harder to their guns as it relates to key economic terms. Headline rate, for example, tends to be not super negotiable. We're spending more time negotiating things like OID, which economic term, but slightly different economic term. And then particularly in the dividend recap transactions, things like call protection, right? That becomes very, very important for sponsors who want to create a little bit of runway. They want to recap the business, create a little bit of runway, but they're still planning on selling the company here in a couple of years. If you're locked into a hard call step schedule, that becomes problematic. And so we've had success actually in negotiating what we call bifurcated call structures, whereby there's a certain call structure, a call table that is effective if there's a refinancing, but if it's a change of control, we kind of carve that out and we have a separate call protection schedule that applies in that instance. So those are the areas where we're spending most of our time focusing from a negotiation perspective. We've got a question here about the types of capital structures that we're seeing. Are we seeing senior junior structures now versus unitranche, given the lower cost of capital? And so this is a question that I'll answer almost agnostic to the use of proceeds, so not specific to dividend recap. There was a period of time really earlier in the year where senior junior structures were very attractive. The blended cost of capital was actually lower in many instances than a unitranche. And when you looked at particularly a fixed junior piece of capital, that cost of capital was very similar to what the floating rate unitranche capital would be, and which doesn't make economic sense, didn't make economic sense for a period of time. I think what we've seen more recently, really post SVB, is that the senior portion of a senior junior structure actually creates a fair amount, I'd say, of execution risk. And so we're still exploring these transactions. We just closed one 2 weeks ago, in fact, a senior junior, where the alternative set that we brought to the table, the options that we brought to the table, that was the most attractive of them. But almost always we're exploring those senior junior capital structures alongside unitranche, simply because of the execution risk associated with the regional banks that you would typically put into the senior portion of those capital structures. It's a little bit backwards. You'd expect the junior capital to be more difficult to source. It's actually quite often the senior capital that's more difficult to source in the senior junior structures nowadays. Good questions. So, and Steve, you might want to jump in here. I'll go first and give my perspective. We have a question about growth companies that have recently turned free cash flow positive. And I might answer a more general question of financial performance. How many quarters of positive financial performance are required before dividend recap is really possible? And I'll share, our experience. We're typically looking for 4 quarters of consistent financial performance that we can point to before the market is really open to a dividend recap, or really, mini financings for that matter. I think the possible exceptions there are where you have clearly identifiable, for example, cost takeout measures that you've done that have driven that financial performance, or if you have contracts where you renegotiate the contracts. And we see a lot of this in automotive right now, for example, where a lot of contracts are being renegotiated. If you can point to those discrete items that have driven positive financial performance, we can explore, and in fact, we are currently exploring a refi in the back of 2 positive quarters post those sorts of initiatives, and the market is somewhat receptive to those as well.
Yeah, I think you really hit the nail on the head. I also think that investors always like to look ahead a couple of quarters and know what's happening in the current market environment. So, in the sense that you have a business that is really very stable, very predictable, very slow growing, a low capex business. Those are all types of environments where a dividend recap is going to be appropriate.
Yeah, and just to add to that, when we talk about forward-looking financials or forecast or visibility, we were working with a client with a portfolio company earlier in the year that was looking to do a sizable debt recap. The company had grown through acquisitions and had a very clearly laid out value creation plan, but it wasn't in a format that the lender could digest. We were able to actually break it down and showcase exactly how the free cash flow was going to be impacted in the following 3 quarters, to the point where the lender gave the company full credit for that value creation work in the diligence phase. Prior to that, again, this is a company where the margin profile was changing dramatically, more than tripling up within a matter of 2 to 3 quarters. So just pointing that out, when you are dealing with growth companies where there is a hockey stick growth, if you digest a lot of that information in your diligence material and make it watertight and defendable for the lender, we are seeing lenders giving credit for those type of initiatives.
And I'll jump in on this next one, Shari. So the question surrounds senior capital conservatism, comparing local or regional banks as against the large top 10. Kind of two questions on this topic. So the short answer is we are seeing a differential in appetite for senior capital as between what we'll call the regional banks and what we call the money center banks. Regional banks being any number, hundreds, in fact, of the regional players, and then money center. We typically talk about being a Bank of America, JP Morgan, Wells Fargo, PNC, that grew. And effectively what's happened post SVB is there's been massive flight in deposits from the regional banks to the money center banks. And so, yes, we are seeing a differential in how those types of institutions react to senior capital opportunities. Regional banks, for the most part, are not extending new credit to new relationships. They're very, very focused on either existing borrowers or existing sponsors where they have that relationship in place. Where they are willing to extend credit, the second question you'll hear in most of those conversations are, can we get the treasury, right? It's kind of an odd turn here as to the ancillary business becoming almost more important than the credit relationship itself. That's as compared to, and in contrast to, I should say, the money center banks, and they are still very much in the business of making loans with new relationships, with existing relationships, new sponsors, existing sponsors, right? So across the board, they're still interested. What has become a challenge is that, as you all probably know, that group of lenders, that group of bank lenders, tends to like larger opportunities, particularly in the cash flow world. They may consider smaller ABL loans, but their cash flow lending practices tend to be a good bit up market than some of the regional players. And so from a size perspective, it becomes a little bit of a question of where can you find the right home for the given opportunity.
Any more questions? I think we answered them all. Okay, if there are no further questions, thank you to everybody for participating in today's call. If you would like to get a copy of this call, please go to our websites or feel free to reach out to any of the gentlemen you see here on the screen. We'll be happy to point you in the right direction. Anything else, Joseph or Shari?
No, thank you for having me, Steve. Thanks, Shari.
Same here. Thanks for your time to join us on the webinar, and look forward to hearing from you. Happy to help if there's on any front that we talked about today.
Great. Thanks, everybody.
Thank you all.